We're going to be talking about real estate and some other related topics. And this is going to be sort of a panel discussion. Each of us is going to present for 20 to 30 minutes. And after each of us presents, we can have a little bit of Q&A. You know, we might talk a little amongst ourselves during the presentation. And I'm Jim Hutcherson. I've been a partner here at Hansman Weevil for about 5 years. Total, I've been here, I think, about 17 years, which is hard to believe. I work mainly on the tax side of the practice. I work in the area of real estate, obviously, and also with professional service businesses, so doctors, lawyers, and work a lot with small businesses and individuals. And we can just do just a quick introduction of each of us. So, Kevin.
I'm Kevin Keller. I work in the accounting and auditing area, but do a fair amount of tax work for some real estate clients and specifically land developers.
In the lobby. That just popped up. That was
I am.
I'm Larry Martin. Been with Hansman Weevil more years than Will mention, and primarily in tax practice, and have covered a variety of topics. And real estate is a big part of Central Virginia's economy, and therefore I think our expertise in the different things we're talking about today are things that we see every day in practice. So hopefully it'll be information that'll be useful on a day-to-day basis.
And I'm Robin Swink. I'm kind of same as Kevin. We work more maybe with financial reporting areas, but then I also do a fair amount of tax work with several different real estate partnerships that hold rental properties or just raw land. Also work with some manufacturers and distributors and so forth. One little quick thing, if you all are not seeing our picture if maybe you're seeing just one of us or two of us, if you'll click those three dots up at the top of your screen, if you have the gallery, if you see that, if you want to go ahead and check that, that might give you a better picture of kind of being able to see all four of us.
Thanks, Robin. And just a few housekeeping items. I'm supposed to remind you that the event is being recorded, so anything you say can and will be used against you in the court of law. I'm just kidding. I've been watching too much Law and Order. No, but anything that you say will be included in the recording, which is going to be available for others to view. And then also, again, the sessions are going to be recorded, so your participation indicates your consent for your voice or your image to be a part of the recording. So please don't disclose any private information during the sessions. And the CPE attendance code words, they will be announced verbally throughout the session. Please don't put them in the chat. The whole point is that everyone should be paying attention and listening for them. So we'll get the first one here soon. We'll wait a few minutes. But I'm going to start the session, and I'm going to be talking about delay there. So I'm going to be talking about passive activities, the real estate professional rules, and then just some general tax credit topics. And Larry, you probably remember when the passive activity rules came out. When did those come out? It was
1986.
1986. So, of course, when I was reviewing my slides yesterday, I get to my first one about the passive activity loss rules, and my mind starts to wander, and I'm like, what other stuff happened in 1986? So I was thinking, who won the Super Bowl in 1986? Well, the Bears beat the Patriots 46-10. These days, it's kind of hard to believe with how successful the Patriots have been and how unsuccessful the Bears have been. Then I started thinking about what other movies were out then. So you remember the movie The Money Pit with Tom Hanks, which is a really funny comedy that came out in 1986. Top Gun with Tom Cruise came out, and then also Ferris Bueller's Day Off. Those movies came out in 86. Those are some classics. So anyway, the passive activity loss rules, something that's all near and dear to our hearts. And I can say this with restrained jubilation that I will not be talking about the CARES Act, PPP loans, or employee retention credits. And I don't think anybody else will. So I think I can hear the crowd cheering from out in the hallway that we're not going to be talking about that. But anyway, let's get started here. So passive activity losses. There's a couple different things there. It's an activity in which the taxpayer does not materially participate, and then also all rental activities, unless you're a real estate professional. So some general rules. So passive activity losses, they're deductible only to the extent of passive income. And so if you have passive income from one activity, it'll free up the loss of another activity, unless of course you're dealing with publicly traded partnerships, or we call them PTPs for short. So PTPs, you only look at those in a silo. So excess passive activity losses, they carry forward indefinitely. They can't be carried back. So the use of PALs, if you generate passive income, or if you,
Is that all it has to do?
I don't, but it's not really supposed to be like that, so.
somebody has their mic on.
You try to find them.
So if you generate passive income, or if you completely dispose of the activity to an unrelated party in a taxable transaction, you can use the passive activity loss. And remember that that passive income is part of the net investment income that goes into the computation of the 3.8% tax. And part of the Build Back Better bill is to expand the application of that net investment income tax. Of course, we don't know when that bill is going to pass or what's going to be in the final version of it, but just keep that in mind, that the reaching arms of the 3.8% tax could get longer. So how do you materially participate in an activity? So there's 7 different tests. And if you look at IRS publication 925, it lists them all out and explains them all. So the main one is if you participate for more than 500 hours in the activity for the year. That's usually the first one you look at. But then the other ones, there are other ways you can meet the test. So if your participation was substantially all the participation, you participate more than 100 hours and no one else spends more time than you spend more than 500 hours in all significant participation activities, then you could be deemed to materially participate in the activity. And a significant participation activity, those are multiple activities that you spend more than 100 hours in, and you don't pass any of the other tests. So if you have several different activities you're working in and spending time in, and you don't spend more than 500 hours in any of those activities, but you do spend more than 100 hours in each one, and collectively you spend more than 500 hours, then you can be deemed to materially participate in those activities. Number 5, you materially participated for any of the 5 of the 10 immediately preceding years. I think we call that the nickel and dime test for short. If you hear someone say the nickel and dime test, that's what they're talking about. Then number 6, you have a personal service activity and you materially participated in any 3 of the prior years to the current year. And personal service activities, that includes health, veterinary services as well, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, or any other trade or business in which capital is not a material income producing factor. And then the last one there, facts and circumstances. So you can materially participate just on the facts and circumstances. However, if you have a big passive loss that's under examination, that's not going to be a good defense. The IRS is going to want to see contemporaneous documentation of your participation. So I wouldn't rely just on the facts and circumstances to argue that you are a material participant. And as I just said, documentation is key. Surprisingly, the regulations, they don't require keeping contemporaneous documentation if you can establish material participation by any other reasonable means. But again, if you're going to get challenged by the IRS, you want to have that documentation of your participation in the activity. So again, the use of passive activity losses, if you generate passive income from another activity or the same activity, or if you completely dispose of the activity to an unrelated party in a taxable transaction. So some transactions that are not a qualifying disposition and your passive activity would not be released are like-kind exchanges, conversion to personal use, transfer and a divorce and gifting, installment sales. So your passive activity loss won't be released in the initial year. It's going to be released over time as you report the gain from the sale. And then also disposition to a related party. is not going to be, a qualifying disposition. So then what about death? What if you have a passive activity and you die? Well, that is considered disposal of the activity, but the allowed loss is going to be reduced by your basis step up. So by the basis step up to the person inheriting the property. So you can't get both. You're going to be allowed to get the basis step up, but then you have to reduce your loss by that basis step up. So as we mentioned right up front, rental activities are all passive by default, unless you're a real estate professional, which we're going to touch on soon. So your participation level really doesn't matter in a rental activity if you're not a real estate professional. Now, there is a small landlord loss allowance where you're allowed to deduct $25,000 against non-passive income if you're a fairly low income taxpayer. So what we see lots of times is someone might have a lot of passive losses coming forward, but they might have a unique situation in their tax return that drops their income. And in that year, they'll get to use $25,000 of that passive loss coming forward that's from a rental activity. And there's a really low threshold of participation you have to meet for it to be considered an active rental real estate, which is, it's kind of weird. The terminology is kind of weird. It's not material participation, it's just called active participation. So you have to own more than 10% of the property. You simply have to participate in management decisions of the activity. So for all of the Hanson Weevil people out there, and also other tax return preparers who may use CCH, you want to make sure that the activity is coded properly in the software. So you want to make sure it's coded as active rental real estate and not other passive. Because if it's just coded as other passive, if you have that drop in income one year, the system's not going to allow that $25,000 loss. So keep in mind, if you have a pass-through activity in our software, the default with no entry is other passive. So you're going to have to go in and change it to active rental real estate. With a Schedule E rental activity, the default is active rental real estate. So real estate professionals. So, with the background that all rental real estate activities are passive, regardless of your participation, real estate professionals can get non-passive losses for rental real estate losses. So you can offset, if you have wage income or other types of income, investment income, you can offset that income with rental losses if you're a real estate professional. And right now, if you do have net income as a real estate professional, you kind of get the best of both worlds. It's not subject to self-employment tax, and it's not subject to the 3.8% net investment income tax. But like I mentioned earlier, part of the Build Back Better bill could change this because they're expanding the 3.8% net investment income tax. And so, you might be thinking, well, I have real estate professionals as clients, and they generate rental losses every year, so I'm not so worried about the 3.8% net investment income tax. But what you got to remember is, every few years, usually a real estate professional will have a big gain from the sale of real estate. And right now, that gain is not subject to the 3.8% net investment income tax. Normally, a passive gain from the sale of passive activity, regular real estate operations would be subject to the 3.8% net investment income tax. So all that could change under the Build Back Better bill. Again, it's not finalized yet. We're not exactly sure when it's going to be passed or what's going to happen with that. So the real estate professional rules, there's really a few different hurdles you have to get over. So you have to own at least one interest in real estate. And then there's the 50% test and the 750-hour test. So the 50% test is half of your personal services must be in the real estate trade or business. So here we're not just talking about rental real estate. We're talking about the rental trader businesses, which we're going to talk more about in just a minute. Then you also have to spend more than 750 hours in real estate trader businesses. Same thing, it's not just rentals, it's real estate trader businesses. And for this test, you're looking only at a taxpayer or the spouse. You can't combine their time together to meet the 750-hour test. So what happens is if you can get over those hurdles, then really what's happened is you've stepped into then just the normal material participation rules for an activity. Basically, once you get past that, then all of your rental real estate is not considered automatically passive. If you get past those hurdles, then you just have to materially participate in your rental activities and they'll be non-passive. And so that's an important distinction, because if you meet those first two tests, your rental real estate activities don't just automatically become non-passive. You have to then materially participate in each rental activity. So most real estate professionals, they usually have a lot of different rental real estate activities. So it may be hard to materially participate in each of those rental activities. So there's a special, the government recognizes this. So in section 469, there's a special election that real estate professionals can make, and it's a special election only to them, that you can make this election to combine all of your rental real estate activities into one activity for the material participation test. And so I can't think of a real estate professional that I've seen that we work on where we don't make this election. And once you make it once, it's good for all future years. I think as a matter of common practice, I usually see us make this election every year just so it's in there so we know it's been made. But once you make it once, it's good for all future years. So for those first tests, the 750-hour test and the 50% test, what are the real estate trader businesses for those tests? Well, it's development, conversion, construction, acquisition, rental and leasing, operation and management, as well as brokerage. So sales agents, so if you have real estate sales agents that, file Schedule C, their time in that business does count for this test. So if you have a real estate agent that works full-time in their Schedule C business, but then they also have a handful of rentals, then more than likely they're probably going to be a real estate professional. And if you can establish the material participation also in their rentals, then they could have non-passive losses from those rentals. Real estate appraisers are, that's not considered the real estate trader business for the real estate professional test. And then also mortgage brokers are also not considered real estate trader businesses for this test. And so also keep in mind, if you're an employee of a company and you get W-2 income, that time does not count in the 50% 750-hour test unless you were at least a 5% owner. So, in general, if you have someone who's a W-2 employee, they're not a 5% greater 5% or greater owner of a real estate business, it's going to be hard for them to meet the real estate professional test, the 50% 750-hour test. So just keep that in mind. And also keep in mind that spending time as an investor doesn't count towards these tests. You have to be involved in the day-to-day management of the business. And again, like I mentioned before, you have to document that both the 50% and 750-hour tests are met, and that you materially participated in each rental activity. You have to be careful in this area because there are cases out there where people have met this the 50% and 750-hour test. They've documented it, and then they think they're done. They're a real estate professional, but where they got beat up by the IRS was they didn't then establish that they materially participated in each of the rental activities, which then is what makes the rental activities non-passive. Okay, so laying that as a background, let's just touch briefly on some general business credits. And what I'm talking about here, I'm not talking about the section 25 non-business credits, so not the, not the credits that have the overall $500 limitation that we see on everybody's personal tax return. I'm talking about general business credits that someone might get through from a pass-through entity. So, why am I mentioning this in a real estate discussion? Well, lots of times, real estate investments do generate these federal tax credits. So they could be energy credits, so including solar, historic rehabilitation, or the low-income housing credit. And so what you have to keep in mind is the passive activity rules do apply to these credits. So if you have a client coming to you that tells you that they're going to invest in a pass-through entity and they're going to get a decent size federal business credit from this investment, you got to stop and think. You want to research the credit so you know exactly what it is. Then you have to determine whether the activity generating the credit is a passive activity to the taxpayer. And I would also suggest, using our tax software or our planning software to test the credit, just to make sure you don't have any surprises when it comes tax time. So with general business credits, assuming they're non-passive, if you can't use it all in the first year because there is an overall income tax limitation described in section 38, it has a 1-year carryback and a 20-year carry forward. So that rule did not change with the NOL carryback and carry forward rules changing recently. The general business credit carryback and carry forward are still the same. But you have to be aware of the passive activity loss limitation. Because this is another area where you can get tripped up. If you have a passive activity that generates a credit to you, you can only utilize that credit if you have tax generated from passive income. And unused credits, because it's passive, those carry forward only. So it's easy to make the mistake of, oh, I have this credit I can't use, it's going to carry forward, but I may have had a big gain in the prior year from the sale of a piece of real estate, so you might think, oh, I can carry that credit back 1 year. Well, if it's hung up due to the passive activity loss rules, that only carries forward, just like passive activity losses. And so if you're a real estate professional, you can enjoy non-passive credits from your real estate activities. And in our tax software, as a tip, if you're testing this out for someone to see how much, say they invest in something and they're going to get $10,000 of solar tax credits passed through to them on a K-1, and you want to test that out based on their tax situation, if it's going to get hung up due to the passive loss rules, if you look at our carry forward schedule, it's going to have both the originating form and the disallowing form as the 8582 CR. So in that case that credit's only going to go forward, not backwards. So as we discussed with the general business credit, if it's a non-passive credit, or if you can get past those passive hurdles, then you're only limited based on the limitations in section 38, which is an overall income tax limitation. So if you use part of the credit and you run out of tax and you can't use it all, then you can carry that back 1 year for 20 years. And in this case, if you look at the carryover schedule, it's going to have the originating form as the form where the credit is coming from. So form 3468 is a form as an example, but that could be different depending on the type of credit. And then the disallowed form is going to be the form 3800. And this is another thing to be aware of, a really big difference between passive losses and passive credits. When you have a passive loss carryover, if you dispose of that activity, you can take that loss in the year of the disposal. Again, it needs to be in a taxable transaction. We went back and talked about a bunch of transactions that were not free of a passive loss. But with passive credit carryovers, if you dispose of that activity, it does not release the passive credit for that reason. if you dispose of the activity and you have a big passive gain from that disposal, then that could generate tax from passive income that will allow you to use the credit. But disposing of the activity on its own does not release the credit. And so that's why you really need to be careful when a client comes to you about an investment they're going to make in a pass-through entity that might give them a pretty decent sized federal credit. That could be their only passive activity in their tax return. So they have this suspended passive credit. Then at some point down the road, they get out of the investment and they still can't use the credit. So it carries forward for a really long time. I mean, I've had that situation before where, a client didn't consult with me about an investment they were doing. When it came tax time, they had gotten allocated, I think, 10,000 of solar credits. And he was under the impression that, that was going to basically take care of a lot of his tax, and that he wouldn't have to make an estimated tax payment. But it turned out that credit carried forward, and he did get to use it eventually, but it took several years for him to be able to. And so that's all the material that I have. If anybody has any questions or comments, I mean, I know Kevin and I recently were looking at these rules for a client that was going to potentially get a significant amount of solar credits from an investment. So we had to look at this to see when they would be able to be used, think about, what would happen if the taxpayer passed away before they were used. Could they be carried back? Would they only be carried forward? So it can be pretty complicated. So again, like I said, it's good to really research, know what the credit is, and test it in the tax software, and don't just assume anything.
So Jim, I have a question, follow up on passive activities.
Sure.
If a taxpayer has been passive for a few years and they've got some suspended losses on their return, but then they become active in that activity, what happens with those suspended losses?
So in that case, if you have an activity that the suspended losses that flips to non-passive, if that specific activity starts to have income, you can use those passive losses. But otherwise, you're going to have passive income from another area to free up those passive losses. If you do dispose of that activity at some point, you can use the passive losses at that point. And that's a good question because lots of times, real estate professionals, they're in a situation where they have a lot of passive losses, and eventually they'll reach the point where they can meet those real estate professional tests. So at that point, they flip to non-passive, but now they have all these passive losses from the prior years, and those passive losses are gonna keep carrying forward unless they start to have income from their activities or if they dispose of an activity. So that is something to be aware of. I mean, if you're going to keep having losses anyway, it's still better to be a real estate professional because you'll start to get to use your losses going forward. But those other losses from prior years may linger for a pretty long time before you. Question.
One other quick question, Jim.
Sure.
It comes up all the time. So if I've got passive loss carry forwards and I create long-term capital gain from a passive activity, say the sale of a rental property or something, that frees up the ordinary deduction. So even though I'm getting a favorable rate on the passive gain, it frees up the ordinary deductions that had been suspended.
That's right. Yeah.
So I think it's so it's actually, and that can be a fairly favorable transaction because the ordinary deduction is freed up from the PAL can actually offset other income in that year while I still get a preferential rate on the sale of the passive activity.
Right. Not zero sum.
Right.
Helene, did you have a question?
Yeah, I had a question for Jim about the aggregating of real estate activities for a real estate professional. So if you've got a real estate professional who's, as part of, has got enough activity to qualify, But then they also are an investor in various real estate, say, partnerships, where they might be a limited partner, but that's throwing off rental income as well. Can you speak to what's necessary for that activity also to be included as one of the non-passive activities?
Sure. That's a good question. I believe if you're a real estate professional and you make that election, then you're combining all of your real estate rental activities into one activity to determine whether or not you're a material participant in those activities. So I believe in your situation, if you make that election and you have rental real estate losses coming from those investments, as long as you make that election, that's going to be all seen as one rental real estate loss really participate in, as long as you've met one of the material participation rules for all of those activities combined into one.
And I guess I had a new client this year that, that she was preparing her own return, and she was very good at, had a lot of technical skills and so forth, but she had ignored the real estate professional rules. And she definitely was in the qualified easily. I mean, that was what she did every day. She had 10 or so more rental properties plus some pass-through K1. So it was good to kind of go through that with her. And it kind of made me think too, as a lot of people have changed some of what they do every day due to COVID or what have you. But it's good to kind of bring that up to some of the clients we talk to, just to make sure that maybe they've transitioned what they're spending their time doing during the year. So you want to make sure that they have the opportunity to take advantage of those rules if they qualify, and they can document them.
But Robin, becoming a real estate professional in 2021 does not impact the years prior to that.
Sure,
It's,
right, yeah.
It's a current and a go forward
Right,
election.
right.
But you can solve the problems going forward. You can't fix, as nor and I believe you cannot fix it by filing an amended return in a prior year. The election to be a real estate professional has to be made on a timely filed return.
Yeah.
Okay.
I don't see anybody else with their hand raised, or anybody have any other questions for Jim?
Code word.
Yeah, I haven't done any code like this. Yeah, I was too into what I was talking about. So we're going to do the first two code words. So the first one is fun, F-U-N.
Yeah.
And the second code word is old, O-L-D. So fun, and then old. All right, so we're going to turn it over to Larry, and he's going to tell us about Virginia conservation easements.
So unlike the passive rules that Jim has been talking about, conservation easements are in perpetuity. And as somebody told me one time, perpetuity is a long, long time. The passive rules are a timing mechanism that suspends things. The conservation easements are something that is permanent and forever. These are important, I think, in our area as we walk through this, but kind of a little background, and we'll talk about the conservation easements in detail. But certainly Albemarle County, and maybe a little bit lesser in some of the surrounding counties, how land is used, how it's preserved, whether it's developed or not is something that's pretty critical, and it also affects a lot of the value of the land. And so where these conservation easements come in is, it does affect what ultimately can be done with that land. And Virginia, by way of background, is got a program where they, in effect, use some tax dollars to encourage this. The federal law has been there for many, many years, where they also give a certain amount of a tax break for conservation easements, which effectively permanently keeps the land from being developed. So let's talk a little bit about what they are. We've seen an awful lot of these. Our clients have participated in them. And then as we get near the end of it, I will talk a little bit about, as we go through the buying and selling of the credits. But so what is a conservation easement? A conservation easement is a permanent deed restriction on the future use of the land. It doesn't matter who owns the land, it is a permanent restriction on that land. It's a little unique in the federal tax law because generally a gift of property has to be an entire interest in the property. In other words, I can't give away fractional interest, I have to give away the entire. Federal tax law makes a specific exemption where I can give away, in this case, a restriction and still get a tax deduction for it. So you give away less than, you still own the land, it's just subject to this easement. So that's fairly unique in tax law. So again, it is a conservation easement. It's done with a deed restriction. It goes with the property. It is perpetual, it's forever. And then the entity that's holding the easement must inspect the property and enforce the restrictions. That's part of their obligation as a organization that can accept these. And so why should somebody place a conservation easement on the property? And it's really, the primary motivation has to be to preserve the nature of the property in perpetuity. In other words, they don't want to see it become a housing development. They don't want to see it become a shopping center. They don't want to see something else commercial done with the property. And this really needs to be the primary motivating factor. Now, in Virginia, there are, and in other states as well, but not quite as lucrative as in Virginia, there are tax savings, including income, estate, and property taxes that go with that easement on the property. So really the reason has to be that the landowner wants to preserve the current nature of the property. So what are some reasons not to place a conservation easement on a property? Well, first off, they are perpetual. And the current owner can't always predict. We've had a lot of discussions with clients where the future needs of the individual or their family or certain future events, while they might like to preserve, the family farm or whatever, they don't necessarily want to put that restriction on their kids because their kids may want to sell the property. They don't have the affinity for it staying as a farm or need the money because it's worth a lot more if it can be developed. But so you really need to think long and hard about, and the family needs to think long and hard about the easement because they are perpetual. And as I said, it permanently restricts it and it diminishes the value of the property. And that's hence where some of the tax consequences come from. But again, you really need to think through because once done, that basically it can be undone. Okay, so let's talk about some of the tax consequences of doing a conservation easement. It is a charitable contribution deductible by the donor. It is subject to limitations on gifts of property, which, as we know, basically are 30% of your AGI. But it does have, unlike gifts of, say, appreciated stock or something, it does have some a little bit different limitations. Generally, property would be subject to a 30% limitation. As I said, however, a conservation easement can go up to 50% of your AGI. And unlike other charitable contribution carry forwards, which have a 5-year limit, the conservation easement has a 15-year carry forward. And this is particularly significant when you have somebody who makes a large, and we've seen a multi-million-dollar charitable contributions. Very few people have enough income to be able to use that up. But with a 15-year carry forward, they basically get to offset half of their income for the next 15 years. There is an exception for farmers, and the farmers are designated by how much of their income is from farming, true farming activities. And Jim and I had one of those where basically the exception for farmers are they can offset 100% of the AGI, and then they still have the 15-year carry forward. So it puts them, the real farmer who is trying to preserve the family farm, and also in effect extract some of the value out through the tax deductions and through the Virginia credits, which we'll talk about in a minute, but not have to, sell the farm to a developer to extract some of that value. The contribution is equal to the diminution in value before and after. So in other words, the property is appraised at its highest and best use before the easement's placed on it. And that could be, used, how many development rights does it have on it, how big a subdivision could be built on it, what is the highest and best use of the property. And then after you put the restrictions on it, you basically, the appraiser values the property, what's it worth now with the restrictions of the conservation easement. And the delta between those is what the contribution is. Typically, and people try to say, oh, it's 35%. Well, no, it's not. Some of them we've seen as low as 20. We've seen some that were as high as like 60%. For example, if I have a piece of property next to a shopping center, the diminution in value would be larger by putting a conservation easement on it than if it was just in the middle of a bunch of other farmland. So, again, it has to be done by the appraisal value. And the deduction, like any gift of property, as we know, if I give away property, any amount that would not have been long-term capital gain had I sold the property is not part of the contribution. So if you just bought the property and you haven't held it for a year, then the deduction is limited, to the basis in the property that you gave away, not the fair market value. So, if you get somebody that's just bought a piece of property and they want to do a conservation easement, then make sure that and sometimes they still work because the highest and best use may be what they just paid for. But be careful and be careful about that. The amount of the contribution deduction reduces the basis in the property, it reduces the value. And even though it's not taxable, and if it's appreciated, and if it's appreciated property, it takes a proportionate amount. If you had a 35% reduction in the value, and that's a contribution, then it'll basically take 35% of the basis of the property. So in Virginia, has a program where they are spending state dollars through a land preservation credit to encourage people to do these. And some people have complained that Albemarle County and Loudoun County and a couple of other, the quote, rich counties have gotten more than their proportionate share. And some of the rural counties, out in Southwest Virginia don't get any benefit from this because the value of the before and after, is not a big number. But the program is there. You do get a deduction for federal purposes, and as we know, any charitable deductions on your federal return carry over to the Virginia return, and so you do get the deduction. However, after recent tax legislation, and we talked this morning about the SALT limitation and how people were trying to work around it, thanks to some people trying to work around it where they were trying to buy state tax credits to get an end run around the SALT limitation. Law now requires that the federal deduction and the Virginia deduction have to be reduced by the amount of the credits received. So the credit in Virginia is 40% of the value of the land preservation credits. So if I give away a conservation easement that's worth $100,000, I get $40,000 in credits. My charitable deduction is now $60,000. It has to be reduced. One of the things that makes Virginia's tax credit fairly unique is that it can be transferred. Colorado has a land preservation credit similar to Virginia, but it can't be transferred. Virginia, I believe, currently is the only state where the land preservation credits can actually be transferred. And therefore, if I can't use them all, I can sell them, which we'll talk about in a few minutes. So it makes them a lot more attractive than some other states. When they're sold, they're typically sold at a discount. Why would, Jim buy some of my land preservation credits? Because he can redeem them. He can buy them from me for 85 cents or 89 cents or 88 cents on a dollar. And then he can turn around and redeem them to pay his taxes at $1 on a dollar. If I am the farmer who's contributed to my property and now I've got a bunch of credits and I basically have no income, or most of my income is sheltered by my contribution deduction, then I don't really need the Virginia tax credits, and I can turn around and sell them somewhere between 85 and 90 cents on the dollar, in effect a way to liquidate or monetize my property. The sale of the credits of the LPCs is taxable income to the seller of the credit. And then there is a transfer fee paid to the state of Virginia through the Department of Taxation. An important thing to remember here is that they only offset Virginia income tax. And you asked about that. So if you've got a client that lives in Maryland, New York, and owns Virginia property, and they make a contribution based on that Virginia property, they get these LPCs, they may not be able to, again, they only offset Virginia tax, and they are inferior to the cross-state credit. So if I'm even a Virginia resident, but most of my income is New York based, and I get a credit for my New York tax, which effectively reduces my Virginia tax to a pretty low number, the LPCs are not worth a lot to me. So, if you've got multi-state tax situation, really, you got to think about that.
We'll do a code word real quick.
Okay.
So the third code word is going to be fashioned. Fashioned. Fashioned.
At some point, Jim, I want to know where these code words are.
When we get to the end, I think when we get to the end.
Okay. So we talked about the income tax consequences. What are the federal and state tax consequences? So
is there any way you can display it on the screen?
Somebody's got their mic on.
He wants to know if you
Yeah.
display the code word on the screen.
How about I put, well, I can't put them in the chat. Never mind. It's against the rules.
Yeah, sorry, they're not displayed, but
Okay, if you can just repeat it, that would be great.
oh yeah, so it's fashioned. Fashioned.
Spelling does not count.
Thank you.
Yep.
Okay. The federal, excuse me, the state tax consequences, as we heard this morning, excuse me, now you have to have an estate in excess of $12 million or $24 million for a couple.
Sorry, Larry, I stopped you. Now you're getting cold. Your muscles are getting cold. Keep it up. Sorry.
I'm trying to figure out where his code word was going. But if you do have federal estate tax consequences, the real property that's subject to the conservation easement is includable in the estate because the donor still owns it, but it typically would be at a lower value due to the restrictions. That also not only affects the estate tax consequence, it does affect the step up in value, the appreciation that we get through the Section 1014 basis adjustment. The property would have a lower value for estate tax purposes, and then when it's sold, it would have a lower value, but presumably still a fair market value subject to the easement. One of the important things about this is also the county real estate taxes. Excuse me. Land use taxation, which many of us are familiar with, if property is used in agricultural use, forestry use, or certain open space use, it gets a very favorable real estate taxation. And one of the provisions of Virginia law is that any property that is subject to a conservation easement is per se land use tax and will be that permanently. So it does reduce, a significant burden, say in Albemarle County or any county, for the annual real estate taxes by simply putting an easement. And unlike the other land use taxation, where people have to go through a lot of annual recertifications or biannual recertifications, land use does not. So, okay. So let's talk about the recipient organizations. There are primarily three in areas: Virginia Outdoors Foundation, which is an outfit created basically by state law that receives these easements and oversees the Nature Conservancy, which is a 501c3. And then Albemarle County has an ACE program, and I don't believe any of the adjoining counties do. But so you give this, they are the recipients to whom you donate the easement. They do have to monitor it. We've worked with some of these, and I know the Nature Conservancy comes out and walks the property and makes sure they've got, it's very well documented what's there when the things are given. So basically, the title holder of the recipient organization has to monitor the use of this. So some other things to consider about is, what impact does giving a conservation easement impact other properties? If I've got some adjoining properties, what impact does putting the conservation easement on property A have on property B? If I have, 200 acres and there's a residence, what we call a curtilage, and, it's the 5 acres that are used with the house, that typically is exempted from the easement. So they have different impacts. So it gets a little bit complicated if it's something other than just a piece of raw farmland. The title holder of the easement, again, VOF or somebody, becomes a title holder of all these property rights. So let's talk real briefly about how do you implement a plan. First off, the landowner needs to develop their goals and objectives. What's the taxpayer trying to achieve? And again, the tax consequences can be a sweetener, but they really can't be or should not be the reason why you would put this on there. One of the next steps is, if I've reached the goal that I want to preserve this, the family farm forever, and I want to get some tax benefits out of it. Okay. Then you talk to the organization that's going to hold the easement, Virginia Outdoors Foundation, Nature Conservancy. We've found over the years that there's a fair amount of flexibility of how restricted, how many potential properties can I still have? I'm giving them 100 acres and I say, okay, there can be 3 properties built on there, or I can hunt on there, or I can do this on there. There's some flexibility in the restrictions that are placed on the land, and they vary a fair amount between different organizations. So, and that will also impact if I give away 100 acres and say nothing can ever be built on it, that's going to have a higher diminution in value than if I give away 100 acres and say 3 houses can be built on it. So, all these come into effect. Excuse me. The real estate appraisal, the appraiser must be a qualified real estate appraiser for this to hold up. And as we go through the steps to implement the plan, there needs to be a deed of easement, which has to have very precise language of what the restrictions are, that they have the certain purpose. It's very exacting. Excuse me. And they should clearly be drafted by an attorney with experience in conservation easements. A flaw in this language can make you lose your charitable deduction and also lose your land preservation credits because the restrictions of the deed didn't conform. So again, don't let a real estate attorney draft that if he or she's not familiar with that. The Form 8283, which we typically get involved in because we're filing the return, must be signed by both the appraiser and the donee organization. It is a critical document. The IRS's point of attack, a lot of conservation easements, has been the 8283, and partially because we're filling it out, we want a good result for our client, but we also have some liability if we don't fill it out correctly. And so, making sure that all the critical information, does he have to put a copy of the deed or the appraisal or something with it. So again, you really have to be careful with the 82, 83. From a Virginia, there's an LPC 1 where you file and you basically get awarded the LPC credits from Virginia, and then an LPC 2 is used to transfer the credits. Sale of the credits. As we mentioned earlier, the sale of the credits is a taxable gain to the seller. They basically they have no basis. Even though you reduce your basis in your land by the amount of the deduction you receive, you have all the credits have zero tax basis. They're not an attribute of the land. They're long-term only if you have held the LPCs long-term. Initially, before there was a lot of guidance, people thought that the LPCs kind of became an attribute of the land. If I'd held the land long-term, I could sell my credits long, and I got long-term gain. Now, if I get the credits issued to me in December of 2021, if I sell them before I've held them for 12 months, the gain is short-term capital gain, doesn't get the favorable tax treatment. So you have to really be careful about this, and we take the position, Hanson Weaver takes the position that it's the date that the LPC credit form is actually issued by the Department of Taxation. Other people will say, it can be the date I applied for them. Some people will say it's the date that I donated the property. But the conservative approach is from the date from the letter. And while the gain is taxable for federal, it is non-taxable for Virginia. So you do get to adjust your capital gains in Virginia. So, if you purchase the credits, you can use them to pay Virginia tax. For 2021, it's $20,000 per taxpayer. So if it's a husband and a wife, it is $40,000. That limit has been as high as $100 a year. It's been $20,000 for the last couple of years. It is deductible as state tax for the amount you paid for the credits, but subject to and it's deductible in the year that you use the credits. But it is part of the $10,000 SALT limit. And so basically this really somewhat becomes a moot point. Theoretically, there's a gain if I pay 90 cents for the cost of the credits and then redeem them at $1. There's supposed to be some gain on that. Most people are kind of shortcutting this a little bit of how they do it with the purchase of the LPCs. But if you've got somebody that bought some LPCs, just make sure be aware of this issue. So one of the things that there's been a lot of recent controversy surrounding conservation and easements, and this arises not from what we're seeing here in Virginia, but a lot of these tax shelter promoters are selling conservation easements, which really are being generated by bogus valuations. If you look at a lot of recent tax court cases and other things, there are people who are buying property, getting initial appraisals that are just absurd, the highest and best use, and then you're putting easements on them. And in effect, it's a kind of a factory thing of, I can go buy property and basically get these conservation easement deductions that are way overvalued. And the tax courts have had, very little trouble basically outlawing a lot of these, and some of these tax shelter deals. So the person who's buying the credit really doesn't own some of the underlying land. They're designed to get a much larger deduction, and a big tax saving is really what the whole thing is designed to do. And again, the tax courts have just kind of routinely blown these up, and they're imposing a lot of significant valuation penalties on them. Unfortunately, most of these have given really kind of tarnished the actual giving of conservation easements, which has been fairly long-standing around here. And there's a significant amount of land, so don't let the kind of the tarnish that's gotten on conservation easements by some of the abuses impact. I think there's still a very workable vehicle for our clients and somebody who wants to, harvest some tax benefits, put a piece of land in an easement in perpetuity and preserve that piece of land. So hopefully a quick overview of Virginia conservation easements. We'll have the thing we probably see more likely every day is people buying the credits to use against their taxes. But we're still seeing some people that are putting easements on pieces of property. So we've got, a fair amount of expertise and experience in that within the firm. So, feel free to, if client approaches you to that, see Jim or me or somebody else up here, and we'll be able to take care of that. So, questions?
So Larry, I did have just a comment. So you mentioned we did have a client that really used the conservation easement and the sale of the credits to really take his farmland. So he was a legitimate farmer, didn't make a lot of money, but he had a lot of land in his family. And, he did want the farmland to continue. He didn't want it to be developed. And so doing the conservation easement gave him a really big charitable deduction, and he generated the credits. And then he was able to immediately sell those credits, convert them into cash, and then use that charitable deduction to offset all the gain. And since he was a legitimate farmer, he got to offset 100% of his income rather than the 50 or 60% limitation. And it just really worked out well for him. It put a lot of money in his pocket as a hard-working farmer, and keeps his land nice going forward in his family. It just really worked as it was supposed to for him.
Yeah, and that's a classic case, Jim, of the one. And that was what it was really designed for. Now, some of the other ones we've seen where the mega rich person, wants to preserve the land, but certainly that particular case was very. And again, at the end of the day, he monetized other money that he could use to live on, et cetera, the value of the family farm without having to sell the family farm to a developer. So it was really, it's a classic case, but don't see as many of those, but we do see them. And so it's, it really, like I say, it worked out extremely well. So.
And like you mentioned, even though he had just gotten the LPC credits, the long-term game applies to how long he held the property itself. Is that right?
No,
okay.
no, it's how long he held the credits. But
Okay.
in this particular case, Robin, number one, he gave the conservation easement in year one. He had to wait until a couple of days into year two because
Gotcha.
it would have affected his income as a farmer. But he sold them, as Jim said, promptly. He didn't care if it was short-term capital gain because in his case, he could offset 100% of his AGI with the conservation easement. So he didn't care about the character of the gain.
Okay.
Most people do care about the character of the gain, but because he had the 100% offset, but he had no basis in them, and the holding period does start on the day the credits were issued. He simply had to wait until he didn't disqualify himself as a farmer. It's interesting, the sale of the credits is not considered farm income, even though they were generated by donating the farm or donating the easement on the farm, but they're not farm income. So, we have to put a little bit of time and distance there, but it worked out.
Robin was testing you on the holding period and you passed. And I think Larry, this was just a really interesting case that we dealt with. And I think in his case, if I remember correctly, once he establishes that charitable deduction that carries forward, as a farmer, he gets he can offset 100% of his AGI in a future year. If he didn't meet the farming test,
It doesn't matter. It doesn't matter. Yes. Once, if he got to the contribution limit is set in the year of the donation, whether it's the 50 or whether it's the 100%, whatever the AGI limit, and that applies regardless of what your income. So he had to be a farmer in year one, the year he gave the money or gave the easement. He did not have to be a farmer in future years.
And if you're, for our tax return preparers, if you're preparing one of these, just be aware, you'll get diagnostics in the tax software, but, you know, there is a lot of documentation you have to attach to the tax return, and it wasn't that long ago where we still would have to attach all this stuff on paper. If someone had a charitable contribution and from an easement, we have to attach a pile of paper to a paper file return, but we can now attach everything electronically. But if you do have a big charitable carry forward, just be aware, because we were doing this guy's tax return in the second year this year, and he still had a big pile of charitable contribution coming forward. And I was a little surprised by the diagnostics and the software I have them in front of me, but there was a lot of diagnostics about, you know, if you have a big charitable contribution carry forward non-cash, you still have to attach the appraisal and everything else again in the second year. So it was, you know, we got it to work and qualify for e-filing, but it was a little tricky. So just be aware of that, our tax return preparers. If you run into these, you have a big charitable contribution coming forward, just pay attention to the diagnostics. You can get it to qualify for e-file, but you may have to tinker with it a little bit.
And I'll, you know, as we close here, Jim, and pass it on to Kevin, I can't overemphasize the care that you have to take on the 8283, because again, the IRS's attack on charitable contributions, not just easements, but others, is they want to find a foot fault in the paperwork.
Right.
And then the contribution value becomes zero. They got tired of arguing about how much it was worth. Zero is a better answer, and so they're looking for technical flaws. And unfortunately, you know, there've been some what I thought were really minor things. For example, leaving the basis number off of an 8283. But the case in front of the tax court was one where it was really an egregious case, and they were looking for a way to disallow it. And this was a way to disallow it, and now they've set a precedent. So again, you really just looking the spots off the 8283. It is really important.
Yeah, one thing Larry helped me with a couple different times was he mentioned you get the charitable deduction, but then that gets reduced by the amount of Virginia credits that you receive. So he kind of helped me put together a schedule that kind of reconciled that back to your federal return. Just again, adding transparency so that the IRS can't raise their brow in some of that documentation.
Yeah, for example, if the appraisal says it was worth $500,000, why are you only taking a $300,000 deduction on the return?
Right.
That's the issue.
One real quick question, Larry. Have you seen, what kind of the time delay that you've seen that from getting the paperwork, taking on your federal return, but then Virginia getting the LPC credits really available? Because I feel like that kind of stretches over a 2-year period.
Typically, they generally, I think Virginia's been the ones where we've applied for the credits. And you can actually do that before you file the federal return. You can, you know,
Okay.
You have to furnish them a copy of the appraisals and what the 8283s would look like and stuff. But I think we found they pretty well promptly, Virginia's still staying pretty much on top of that. They have a special unit that just does credit, and primarily the LPCs. And I think they turned them around.
Yeah, I would say that was pretty quick. I think with that one that we had was the biggest delay maybe in the attorney paperwork for the conservation easement and drafting all that up was maybe that.
Right, well, they had some type, yeah, and again, we need to move on, but
Yeah.
this was interesting because it was on the border of Greene and Madison County, and the property hadn't been surveyed in a lot of years. And turned out that due to one of the floods, the river had actually rerouted, and part of the land was now in Madison County instead of Greene County. It didn't have a parcel number, and the attorney, it wasn't much of the conservation easement, it was describing what they were giving away. So it had some twists and turns in that stuff. But
Any other questions you all have? I don't see any hands raised.
So I'm gonna do the next code word. All right, so the next code word, this is code word number 4. It's Griswold, GRISWOLD, Griswold. Again, GRISWOLD. Might be thinking about the movie. So next up, we got Kevin.
All right. Let's get into some land developers.
and those not the guys that, because I gave put an easement on my property, so I don't want to see you.
Why you did it, right? Yeah.
So here, you really need to talk about the scope of the project. You need to kind of sort of get a big picture at the beginning of what the intention of the development is, because you got to have an idea of sort of what the number of phases, the timing, how it's going to happen, because all this is going to impact in the decisions and determination of how you're going to allocate costs within the project, and ultimately how the costs are going to get allocated out to the basis of lots sold, which is, you know, all land developers want to know how they can recover their development costs, usually as soon as possible. So for purposes of illustration, as I talk through some of these points, if I had a picture for you, think of that I'm going to buy a big piece of property. I'm going to develop it. I'm going to make it a residential subdivision. And I'm going to cut off a piece of it so that I've got some undeveloped land, maybe in the back that I can do in the future. But I'm going to do a major part in the beginning, and I'm going to do it, say, over 10 phases, phases A through J. And it'll probably take me 4 or 5 years maybe to get through the first section. So it's pretty large scale. So along with that, what helps to accumulate and capture the cost is all developers have to budget for their costs when they go get financing and things like that, and they just evaluate the total profitability of their project. So it's sort of the best practice if you can align sort of your accounting system or software with some of the budget line items of the cost that's going to be incurred, because it's important in the tax allocation ultimately that where you're going to allocate cost at. And if you've got a more sophisticated accounting system, you may be able to break it down in details as you're recording the cost. I've seen other developers will generally use, they could use QuickBooks or some other software to maybe capture total cost, such as roads or something, and then they'll use Excel spreadsheets and other items to take those totals and allocate them among the different phases within the development. So getting into the capitalization of some of the costs, it's important for distinction between what may be direct into a specific phase and what may be common to all phases of the project. So if you think about a developer incurring costs for like roads, water, sewer, usually, like in my illustration, a developer, it's more economical and maybe efficient for them to say if they build a road, a primary road, they'll stretch it maybe all the way back through the development or a good portion of it to begin with. And usually I refer to that kind of as a spine road. And then as they come off and do each phase of the project, say phase A, B, C, they'll just do the subdivision roads and connect out to the main road. So the main road, and the same would apply for like water and sewer lines, main lines that stretch the whole project and benefit all the phases, versus the individual connections that are going to happen in each phase of the subdivision. So the cost within each phase of the subdivision are sort of the direct costs specific to that, and then you have your common costs, which may be benefiting all of the phases. Another thing developers will typically do is amenities. They may put swimming pools, tennis courts, clubhouses, playgrounds, things of that within their development. Again, a common cost that would benefit all phases. Also, with amenities, sometimes a developer may choose to operate them separately. So it's important as to how it's going to be structured. So if a developer keeps title to the amenities and does not intend to deed them over to, say, an owner's association or the property development, then they're going to sort of operate those in a separate entity, and it would be like regular depreciation. but most developers will deed these amenities over to the property, and that allows them to include those amenities in the basis of the lots that they're selling. Same with what I might refer to as soft costs. You're going to have a lot of planning, engineering, bonds, permits, and all those items that are going on within a development. They're going again to be, it could be things that may benefit the entire development that would be common, or it could be items that are going to be specific to an individual phase. So all very important when you get down to actually trying to allocate out to the phases. And as developments go along, there's always going to be changes, and tweaks and adjustments can be made at that time. You start out with a master plan, and then you may change things up. So there's always changes happening, and you have to be reasonable within how you're going to say each one of these costs affect a specific part of the development. Selling costs, they're normally expensed, and that's just a common practice. In general and administrative costs, here, some of your indirect costs, they have to be capitalized as part of the cost of the development. Usually that's done, the IRS says you can use reasonable methods, and they also provide, I think, what they call a simplified service cost method, which is based on a formula. But usually I've seen it just done more on, okay, what's reasonable, such as if I have a project manager, where do they spend their time, and what percentage of their time is spent in the actual development versus maybe an administrative function. Same thing with professional fees. So I think the main thing here is I've always worked with my clients saying it's got to be reasonable, and you got to have a little bit of documentation to support what you're going to capitalize versus what you want to just expense currently. Real estate taxes and interest, they kind of fall under, I think, the UNICAP rules in the code with 263A. Real estate taxes, if development is underway, you're required to capitalize real estate taxes. Now, I did see a point when I was looking at some information that a tax court did hold that if there's an intention to develop the property, then you must capitalize the real estate taxes as well. I think, again, judgments are involved as to, so in my example, say I was going to do 10 sections, but maybe I'm only doing the first 3, and I'm not even touching the back sections yet. So there could be a break in judgments as to when you're going to capitalize real estate taxes. Interest, there's a term that they use called the avoided cost method. Basically, interest on any debt is usually going to be subject to capitalization. They use the terms, you can trace them to production expenses, which is sort of obvious, but also non-trace debt, which may not be associated with a production cost, is deemed to be production cost because you could have avoided. And so therefore you have to subject that interest to capitalization. And there's a formula that you can use based on your accumulated expenditures times your capital interest rate. And you go through that whole calculation. Obviously the interest is limited to whatever you've actually incurred at the entity level. So you don't capitalize more than that. However, there is also a little thing to be aware of for pass-through entities is if it is possible that you could be required at the owner level for them to capitalize a portion of interest on their eligible debt that is related to the project. So for example, say you had a couple owners that put in $100,000 each as a contribution to the project. And then the project went out and financed another $500,000. So they used all $700,000 in development. So what the IRS has kind of in their language is, well, your production expenses exceeded your debt on the entity, but if there's eligible debt at the pass-through level that's kind of traced to those production expenses, then the owners may have to capitalize a portion of their interest, and they would deduct that over time as the lots are sold. Again, judgment calls on that. I think if it gets down to significance, I mean, these are my views as to whether or not how hard you might need to look at that. But just want to make you aware that is out there for pass-through entities. Okay. So after we've determined, we've got all these costs that we've capitalized, now we're getting ready to allocate them out to our phases. How are we going to do that? So when you had your initial purchase of the land, you would look at that, and the developer is going to look at his plans and see how he's going to break it up. So that original acquisition of land may be allocated out to the phases based on like fair values. Just remember that if you buy a piece of raw land and you say so much per acre, well, once a developer splits it into different sections, those pieces may be valuable than others because topography could be bad on certain sections. There could be a floodplain involved, so you just don't want to allocate all your land out just evenly or so. I think you need to look at what the values are. The specific identification, that goes kind of back to, okay, you've got your direct, your common cost, and all your indirect costs. So what phases are those benefiting? And that's the buckets that they should be dropped in. One item again on that is, I think, you might hear me use the word judgment a lot, or reasonable. When you talk about common costs, and I was talking about these primary roads or primary water and sewer, some developers may look at it and say, okay, I had to do this. And even though I am only doing the first 5 of my 10 phases right now, I might want to try to front load some of my costs because I've incurred them. And, even if I don't develop anything else later, I want to take advantage and try to recover some of these costs now, rather than just looking at it and saying, I've got to allocate this to all 10 phases. Now, if you do that, I would say that you want to have, again, documentation or some reasonable rationale, just in case you would ever get questioned on that, because of course the IRS is going to say you should have allocated it to all the phases that it's benefiting. Okay, now we get into estimated cost to complete. So developers, they need to follow the economic performance rules, which basically say, have you incurred the cost? So if a developer, whether they're using the cash or the accrual method of accounting, if they haven't incurred the costs, you wouldn't be able to charge out anything against the lot basis. So the IRS, through this Rev Proc 92-29, is sort of providing relief on this, because in large-scale developments, these common improvement costs are going to be incurred over a certain amount of time. And that way, if you follow this Rev Proc, you're allowed to account for estimated costs to complete and include them in the basis of your lots that you're selling. Now, that does not come without a price tag. If you want to go down, and I would say it's more probably something to look at if it's going to be a large development over a longer period of time. If you're going to do a short development that might be done in 2 years, or it's probably not worth to go down this path. But this needs IRS consent. And for your estimated cost to complete, you have to be contractually obligated to provide for those common improvements. So again, back to my amenity example, somewhere within the association documents or the other sales documents where the buyers are buying these property, there has to be an obligation that you are going to build these amenities. You just can't put them in this request without some type of obligation to do it. And that would go for anything that you're going to include as a common cost in this request. You have to file this. This is filed on a project by project basis. So this is key for this concept, because project here means what you deem within that project. So in my example, I could say in my residential development, phase A, B, and C is one project under my RevProc, and I account for everything that's happening in A, B, and C as a project. And that becomes important, as you'll see just in a bit. You also, another key factor here is the taxpayer has to agree to extend the statute of limitations from 3 to 6 years to allow the IRS to come back in for that long, and if they want to look or examine your records. You have to file an annual statement on the projects. So let's say you do this RevProc and you have 3 projects going on. Every year you have to file a statement to the IRS on each project that has specific information telling them what costs you're incurring and just the status, how much basis you're charging out in lots, etc. If you have such a large project and you're going not to be able to complete all these estimated costs before the statute of limitations runs out, you can file a supplemental request. And of course, if you do not follow any of these provisions under this RevProc, the IRS is going to deny any of the benefits that is being allowed under it. And this RevProc is also commonly, you might hear someone refer to as an alternative cost method. That's what I'm describing. So as I mentioned, the projects determination is critical because every year you have to do a calculation to see whether you have a limitation on the cost that you're charging out on the basis of lots. And that, going back to my example, if I have project 1, phase A, B, and C, the actual costs that I have incurred for all 3 of those phases has to be greater than the costs that I have charged out in the basis of those lots that I sold in those phases. So if that doesn't happen, you're limited to your actual costs incurred, and you would just carry over until that limitation in future years until you actually flip back over and incur the cost. Under this RevProc, you cannot amend prior year returns. So obviously you're going to have refinements of your estimated cost as the project goes on. Changes are going to be made. So there's usually 2 options allowed there. You can sort of flush through a change in your cost in the current year, which means if you go back and look at the allocations that you've done and you would you substitute in what your revised number is to see how that would affected what the basis that you charged out to the lots that are already sold, you can kind of flush through and catch up. Or what's typically done is you would adjust the basis of the remaining lots that you have on hand and recover it through future sales. Okay. So we've been through all that. So now we're going to allocate our cost of lot sales, which the typical, so we've got our cost, let's say, assigned to phase A, and we start selling out of phase A. Typically, you use the relative sales value method where a developer will look and say, okay, in phase A, I can sell 60 lots. I'm going to estimate what my sales price is for each lot. So there, you would just then take your total cost that you've allocated into phase A and spread them to each lot based on that sales value ratios. The IRS does allow you to use other reasonable methods. I think you just need to be careful if you go down that road, because I generally just see that the relative sales value method will produce the best results for reporting the tax effects. And once you choose this allocation method, that is a method of accounting that the IRS says, and therefore you cannot change it unless you get their consent. So you want to be careful. You just can't flip-flop back between how you want to allocate your cost out to the lots. Some other things, let's say, I've been selling out of phase A for a while. So what happens if I have some costs that come up to phase A? Usually what I do is kind of look at how many lots may be left as to whether or not you just need to put those costs in the rest of the lots in phase A and get them as you sell them, or whether or not due to the nature of those costs or such, or that the section may be substantially sold out, I would just expense those costs as sort of an as-built cost or something to that effect. If you remember, I mentioned at the beginning that I bought a large piece of land. I had a bunch of undeveloped land in the back that I might want to do at some future time. There is consideration to be given to if developers have these situations, that possibly they would want to put undeveloped land in a separate entity, especially if they think they're not going to touch it for a year or so. And then at the point where they're ready to develop, they could sell that land into their development entity, and if they meet all the conditions, recognize capital gains on the sale of that undeveloped land, and then that would give them a higher basis in the development entity to write off against their ordinary income. And don't forget about cash flow, because usually developers are cash poor at the beginning, because they have to have a lot of financing for their development costs. So when you're looking at these allocation methods and such, you don't want to unnecessarily do something that could create an unintended large amount of taxable income, because you may not have been looking at the development correctly and using an incorrect allocation for your different phases. The other thing is developers are a dealer, so they're not, they cannot use the installment method for sales. There are certain exceptions for that. Okay, what else? Let me leave some time for Rob. So any questions on that?
Real quick, I do think it's important what you said about the undeveloped land, because I've seen people do that and that's been successful. A lot of times, I think it's a suggestion you get third party maybe involved if you're going to move it from an entity like this to a new entity. But I mean, I think that's worked really well for lots of our clients that have done that and been able to get the cap gain treatment.
I think where you buy a piece of land and you're not going to develop it for, over an extended period, 5 or 10 years, given the propensity for the appreciation in the land, this whole methodology of holding it in a separate entity and then selling it. So it basically allows you to harvest the appreciation that occurred in the land. And as Kevin said, you end up with a higher, and you'll end up ultimately with the same amount of income, but if I can harvest part of that at the favorable long-term capital gains rates, and there are methodologies to this, but I guess I'd say it needs to be a plan from the beginning. I mean, when a client gets ready to acquire the piece of property, you need to really sit down, and that was one of the first things that Kevin talked about. What's this thing will look like over 5 or 10 years, particularly significant developments. They take a long time, but there are some real tax benefits to be had, both from timing and character, if we can do that. So.
Thanks, Kevin. We got the fifth code word coming up. Fifth code word is family, F-A-M-I-L-Y. family. So Robin, you're up
I'm gonna,
next.
this
You got-
worked out just as I
you got
planned,
five
in case you all were
5
wondering.
minutes.
Yes, you got 5 minutes. You can talk about whatever you want, 5 minutes.
We should just play a game, right? Oh, let's see, okay. I'm doing this, so here we go. Let's see, question. Okay, construction terms and topics. Okay, we're gonna speed read. No filler. But seriously, I was gonna just touch on a few things, nothing really groundbreaking or new, since I don't think any of us know what the new tax laws, might bring along, but, just gonna hit on a few highlights. So, let's see. I guess in general, a lot of our clients are able to take advantage of the small contractor exemption, and the alternative to that would be that the IRS has subscribed under 460 that if you're a large contractor, then you have to use the percentage of completion method when you file your tax return. But there are this exemption offered. There's 3 requirements to fall under the exemption. The first one is your contracts must be construction in nature. They can't be any type of manufacturing. And, construction in general means you're working on real property for the most part. Manufacturing in general contracts kind of usually deal with personal property. The contract must be less than 2 years. And it's interesting when they use the term long-term contract. Long-term can mean it crosses a taxable year. But in this case, it's really meaning the contract itself is for more than 2 years. So if it's less than 2 years, then you can maybe be part of this exemption. The third requirement is that if you look at your average gross receipts for 3 taxable years, you cannot exceed 25 million. Now that was a big deal for a lot of our clients. That number used to be 10 million. But when the TCJA came out, they said, whoop, we're going to increase it up to 25 million. So that made kind of a lot of our clients kind of perk up and say, hey, can I do this? And basically, why does that matter? Most of our contractors, again, they're looking for ways to lessen their tax liability. And by being able to fall under this exemption, they were able to choose other methods for recognizing income for tax purposes. These are the 4 types of income recognition methods. Again, percentage of completion, that's kind of the prescribed method if you're a large contractor. Now you can choose to use that even if you do fall under the small contractor exemption. These other methods that are offered if you fall under this case would be completed contract, cash, and accrual. Here's some advantages and disadvantages maybe for those. So percentage of completion, the good news is if you're using GAAP to report for financial purposes, you're using the same method for tax. So that makes, less professional fees may be required to switch from one to the other. Percentage of completion that minimizes the AMT effects. And if we have time, we'll touch on that real quick. And I'll just go through these quickly. Completed contract, that's probably the most advantageous reason for people to want to fall under this exemption. That probably allows the biggest opportunity to defer your income until a later year. It's kind of obviously you're waiting until the contract is completely done before you have to pick that up. Some of the disadvantages for that though is, let's say one of your contracts was going to end up in a loss, then guess what? You got to wait also for those losses until the contract is complete. So sometimes you might be coming out of pocket with things and then you're not getting those losses maybe until a later year. Some other disadvantages is if you choose this, if you fall under the exemption and choose this method, then you have to keep 2 sets of books. If you're doing financial reporting for a third party, you have to do GAAP for that, and then maybe completed contract for tax. We'll touch on AMT considerations, and the IRS, they're like, that's not percentage of completion. So they might raise their brow to see, making sure you do qualify and follow the steps. Cash, that's just what it says. It's pretty easy to account for. If you spend cash, you can deduct it. If you collect cash, you have to pick it up as income. And accrual, I think we're all pretty familiar with both of these methods. But again, if you kind of pick up the income as it's earned. We know RevRec has changed a lot of the definitions for that per se. And then your expenses are taken in the same method. Flipping on over. So AMT. So this was the big thing that kind of the big hurdle. Gosh, I don't have much time, Jim. It's like 2:40. But just real quick. So if you decide to use one of these other methods, please keep in mind that AMT, you will be subject to AMT add back, or it could be a subtraction, but basically what the IRS is going to do, they're going to say, okay, if you did your revenue recognition as percentage completion, but you chose to do completed contract, they're going to make you take the difference and it gets added back and passed through an S corp, partnership, sole proprietor. And that actually hit a couple of our bigger clients. Real quick, the AMT laws, I don't have them up here. The AMT laws kind of raised the exemptions up to over $1 million for married filing jointly couples. But yet some of our clients did get thrown into that realm, and so we ended up not switching because it was more of a tax impact based on these AMT adjustments. So I know I didn't get to touch on everything, but that's a big consideration. But main thing is, if you have a construction client or if you're in the construction industry, kind of just be mindful that you have some of these options available, and you should evaluate them each year by contract, because potentially you could have some tax savings that could help you.
And Robin, your point on AMT is a real good one, because I don't work with many construction contractors, but the one I do work with, they did switch. And so they did get put into AMT. So it was some deferral for them when they switched, but it kind of smooths it out, because now they're getting the AMT credits. So
Okay,
rather
good.
than it being,
That's a good point.
rather than it being, a huge deferral, it just kind of smooths that out a little bit. So it was savings, but not as much if it wasn't for the AMT kind of cuts it back.
All of that comes down to, it's timing.
It is.
But timing's important, because if I've taken all the cash I've got, poured it back into the project, I don't have money to pay tax. So if I can defer that tax, then, but whether it's an AMT credits or whatever, it's a smoothing factor.
So the last code word, number 6, is Christmas. You all know how to spell Christmas. So that's the last code word. I want to thank you for your attention. Thank you, Kevin, Larry, Robin, for doing this with us. This was, I think it was really good. It was interesting, fun to present. So thanks, everybody.